Understanding tax structures. There are three basic types of tax structures: proportional, progressive, regressive. Proportional or flat tax. That's a constant rate applied to all levels of income or purchases. The example would be just a flat 21%. Progressive. Higher income leads to higher tax rates. Federal income tax is progressive, meaning those who earn more pay at a higher rate. So if your income is lower, you would pay, say, at a 7%. As your income went up, you would be approaching 28, 35%. Regressive. Lower income individuals pay a higher percentage of their income compared to higher income individuals. An example would be a Social Security tax, which caps taxable income at a certain level, making it regressive as income increases. Although it is going up substantially. It started out at a number pretty close to what starting salaries are for the average American, and currently the max that you would pay in is substantially higher than most people get as a starting salary out of college, or substantially higher than the average job. So federal taxes, you have income tax. This is the most significant source of revenue, making up 60% of the federal taxes. It is applied to individuals, corporations, estates, and trusts. There are also some other types of taxes that you would see federally, like the road tax, etc. Employment taxes. These include FICA, the Social Security, which is 12.4%, and Medicare, which is 2.9%. Employers and employees split these taxes equally. The self-employed individuals pay the full amount. So if you work for somebody, your employer will pay half of this amount and you'll pay the other half. And again, these amounts for the Social Security part only extend up to a certain range, which change over time, but it's pretty close to $170,000 a year currently. Excise taxes. See, these are levied on specific goods like gasoline, alcohol, tobacco. Unlike sales tax, excise taxes are based on quantity rather than price. Evaluating tax systems. Tax systems are judged based on sufficiency, providing enough revenue, equity, fairness in distribution, certainty, ease of understanding, convenience, ease of payment, and economy, minimizing cost. Taxes should be designed to fund governmental functions while distributing the tax burden fairly across all taxpayers. Tax equity. You have horizontal and vertical. Horizontal equity, taxpayers with similar income and purchases should pay the same tax. Vertical equity. Taxpayers with a greater ability to pay should contribute more, either through higher dollar amounts or higher tax rates. Types of state and local taxes. States typically impose sales tax on goods and services, property taxes based on real estate value, and income taxes. Local taxes also include the use of taxes designed to level the playing field between local and out-of-state purchases. So let's now look at an example here. So this is just, again, we're back to a blank 1040. It's not anyone particular. We're using an example. This is Intuit's ProConnect online tax. So this is a service that would help you provide tax return preparation. So here we have, again, just made up information. This is the San Jose Police Department. Theoretically, this is their ID number. We have we go to general. So if we go to general client information, this is Bill Johns, our made-up person. He's a fireman working for the police department, apparently. Let's not make him so old. And so obviously 1, 2, 3, 4, 5, this is a made-up Social Security number. And let's go back to income, wages. So this is a W-2. So this is his W-2 he got from the San Jose Police Department. If we go through, he made $175,000. Let's go ahead and let's make this 115. Federal income tax withheld, 11,500. So you can see, so we're currently, this is a 2023 tax return. You can see here, whoops. So this was the limit for 2023. So the software automatically puts in the limit, but see if we can refresh it and see if it updates. We may have to, okay. So the first time you put in the amount, if it's over this, it keeps that. So when we edit it, we have to go back and reset it. Hopefully that makes sense. So basically when this is all blank, basically what happens is you type in, say 200,000, it will automatically do the limits that apply. But if you edit over it, you've got to go back and then you got to fill out the whole thing. So as you can see, so here's Social Security. It's 115,000. This is the Social Security tax. Here, let's just go ahead and see. Let's see what happens if we go ahead and do all that. See, it goes ahead and it self-calculates everything for you, except for federal income tax withheld, because that's the amount that is taken from your wages to pay your income tax. And it's based on a guideline, so it could be any number. It's not self-calculating, whereas these numbers down here are self-calculating because it's just the math. It's just, as you saw, the percentages before. So if we review the return, here, so this is his W-2 amount, 115. This is all he owes. This is standard deductions. Come down here, and as you see, everything else is you don't see here because his employer hasn't paid half of this amount, and he has had half withheld. So this is all we need to know for this. We keep track of this because if he had another job and he exceeded the max, he would get it back, because no matter how many jobs you have, there's just one limit. So, but let's assume that he also has self-employment income. Now on the self-employment income, I have purchases of 10,000. So let's make it bigger than that. Let's say 40,000. So let's refresh his form. Come in here. So now you see he has some additional income from Schedule 1, line 10. So as you see, business income, attached Schedule C. Here's the Schedule C. So we had $40,000 in gross. He had $10,000 in supplies, cost of goods sold. Gave him a net of 30. So this is different because he's self-employed. So if he's self-employed, he also fills out the Schedule SE. Here's his info. He has 30,000 of net profit from his business. That's what they're calculating the Social Security from. Basically, I don't know the easy way to describe it, but if you're self-employed, you only pay it on 92.35%. And basically it's just giving you a deduction for the half of the half of the Social Security. Here again, this is the limit for 2023. So that's a total limit. You don't pay Social Security over that amount. He already had the 115 from his W-2. So he's got that much left. So this is his half. This is the whole amount he pays for Social Security and Medicare taxes. He pays the whole thing. It was just self-employment income. So he didn't prepay it or anything. So he pays it all now. But since he's self-employed, he does get a deduction for that other half that the employer pays. So when you get a W-2, your employer gets to deduct that half that they have to pay. So here's that additional half. You'll see that on the tax return as a deduction. Here you go. So it's on the Schedule 2 self-employment tax, Schedule SC. This is his other taxes. And then this is his business income. And that is the deductible self-employment. Again, to look at this 1040 again. So this is the W-2 wages. Here's the net self-employment income. Here's that 2119, the adjustment to lower his income. This is a standard deduction he's taking. He gets a qualified business income deduction for the self-employment income. That might go away in 2025. This is his tax, total tax. This is from his W-2 he paid in. And for self-employment, he hadn't paid anything in yet. He would do that here under payments. Whoops, sorry. Let's get rid of this. We go into payments, estimated tax payments. So here's where all his payments are. Let's assume he just made, let's say he just paid $8,000 on, let's say he just made this one payment. Let's refresh our form. So now we go down, as you can see, he now has paid estimated tax payments of $8,000. Those are what we just put in, estimated tax payments and amount applied from the year before. So he put in $8,000. So now he's paid in the $11,500 on his W-2, and he paid in $8,000 that he wrote a check, or he direct deposited his own money into the account so that he wouldn't owe at the end of the year. That gets him overpaid $644. He will get a check for $644 unless we go into his next year's. So this is next year's taxes, and we can select to apply a refund to the first quarter, however you want, apply entire refund, and then make no estimates. So let's pick that option. Refresh this form. And as you see, now he's not getting a refund. He's instead opting to take that $644 and he will apply it to next year. Amount of line 34 you want applied to your 24 estimated taxes. So he'll go ahead and have that $644. The one benefit of it is he gets immediate credit as of like January 1st. So even if he filed his tax return super late, having this roll over keeps the money on account. So it gives you credit like you paid it at the very beginning of the year. All right. So you can take a look at it, but pretty simple, straightforward subject as far as the end of chapter 1. Thanks.